Hello everyone. This is Sushant from Contra by Quantitative. I am pleased to welcome you today in our webinar session that's been brought to you by Contra. We are glad to welcome all of you participants from more than 75 countries. Today's topic of the webinar session is basics of mean reversion strategies, which will be explained by Dr. Ernest Chan, who is a leading thought leader in algorithmic and quantitative trading. I'm pleased to have Dr. Chan as our speaker today. Dr. Chan is live with us and will shortly take you through the session. The session will start with stationarity of time series, which is one of the critical conditions for mean reversion strategies, followed by how to test for stationarity using ADF or augmented Dickey-Fuller test. Dr. Chan will also talk about cointegration and correlation of pairs and how these two concepts are different. And once we know these things, Dr. Chan will take you through mean reversion strategy concepts. Just to let you know that all of you can type in your queries at any point during the webinar session, and we will take them up in the Q&A session at the end of the session. Post the Q&A session, we will have a quick survey. Now, before we start, just a few words about Quantitative and Contra. Quantitative is one of Asia's pioneer algorithmic trading research and trading institute focused on preparing financial market professionals for the contemporary field of algorithmic and quantitative trading. Over 20,000 professionals from 125 plus countries have been benefited from Quantitative's educational initiatives. Now to talk about Contra. Contra is an e-learning portal by Quantitative that specializes in algorithmic and quantitative trading. Contra offers self-paced courses, which is a mix of videos, audios, presentations, multiple choice questions, and AI-based interactive exercises. Contra also offers a practical hands-on learning experience, empowering students to learn and implement complex concepts easily. Our today's speaker, Dr. Ernest Chan, is the researcher at IBM. I was a researcher at IBM TJ Watson Lab in machine learning. He was also associated as a quantitative researcher or trader for Morgan Stanley, Credit Suisse, and various hedge funds. He is currently serving as principal of QTS Capital Management, which manages a hedge fund as well as client accounts. This is based in Canada. Dr. Chan is also author to several books, few of which are listed here. Dr. Chan also writes a successful blog on quantitative and trading strategies. Dr. Chan, what I'm going to do now is pass the control over to you so that we can go ahead and start with our presentation. Please unmute your mic and let's go ahead and get started. Thank you for joining us today, Dr. Chan. Please go ahead.
Thank you very much for the kind introduction, Sushant. I'm very pleased to be here. Thank you also to everyone who took their time to attend this webinar. Let me make sure that I am on. Okay, great. Okay. Okay, I'm sure that I hope that everybody are able to view my screen. Okay. Okay, so you know, before I go into the specific kind of trading that I will be teaching in that course, let's talk in general about statistical arbitrage strategies. This is a term that is been used very generally, and it is one of the most popular type of strategies in quantitative trading. One of the statistical arbitrage strategy many people are familiar with is the directional trading. You are just trading you know, one instrument signals independently of any others, whether this instrument is crude oil future or the Google stock or some other instrument like Bitcoin, for example. You don't care how other instruments behave. You only care about the history and perhaps the fundamental indicators relevant to this particular instrument. So that's directional trading. The other kind of statistical arbitrage is closer to what we're going to discuss. That's pairs and other co-integrated portfolio trading. In this type of trading, the signals, the trading signals depend on the relative value between two or more instruments. That's why there's the term pairs, but it doesn't have to be just two instruments. For example, Apple versus Google. It could be an entire portfolio, such as 5 technology stocks: Apple, Google, Amazon, Microsoft, Facebook could form a portfolio. And if they are found to be quote unquote co-integrated, we can trade them using this type of setup strategy. Now, what do I mean by co-integrated? We will explain in a little bit, and also we'll explain in detail in the course. There is also the type of strategy called index arbitrage. In this case, we are trading the relative value, and I emphasize the term relative value. We are not trading we are not trying to predict whether the index is going to go up or down, whether the stock is going to go up or down. We are trying to predict whether the relative value of two stocks, or whether the relative value between an index and a basket of stocks is going to go up or down. So in index arbitrage, the signals depend on the relative value between the basket of instruments and an index future. The traditional index arbitrage, the basket of instrument will compose of all the components of the index, with capital allocation in the exact same amount as the index. But that kind of index arbitrage is no longer profitable. So what we will discuss in this course is a kind of index arbitrage, modified index arbitrage, where the basket of instruments are selected based on some criteria, not simply to replicate exactly what the index is. Going beyond index arbitrage, we can have the long-short portfolio. Now, the long-short portfolio, again, the long portfolio could have many stocks, and the short portfolio have many stocks. And the signal typically depend on the ranking of the component based on some criteria. This criteria is often called a factor. So we are oftentimes ranking the stocks based on some factor or a collection of factors. And we will long the portfolio that with the stocks that are higher rank in these factors, and short the portfolio that are lower rank. So typically the long short portfolio have numerous components, many more than a pair trading portfolio or a co-integrated portfolio, or even an index arbitrage portfolio. Now, as I mentioned, the criteria is often called factor, and factor models is one type of long-short portfolio, and there can be many type of factors. It could be statistical factors. It could be factors as simple as using a technical indicator, or it could be complicated factors that are created from principal component analysis, or it could be fundamental factors that are extracted from the financial statements of companies. But factor model is a very vast subject. It will not be covered in this course, but I would just include it as the one type of statistical arbitrage strategies that people often trade. So what we will focus in this course is the pairs trading strategy and the portfolio trading strategy, and a little bit of index arbitrage and long-short portfolio models. And in particular, there's one thing in common amongst all these strategies that we will discuss, and it is that they are mean reverting strategies. We will discuss in a little bit what mean reversion means, but before we do that, we have to discuss the concept of stationarity, because stationarity forms the basis of mean reverting strategy. A time series is called stationary if it doesn't wander off to infinity as time goes on. Now, a random walk, or a geometric random walk for those who are sophisticated, is not a stationary time series. So, for example, let's look at the price of gold as represented by the ETF GLD. It is undergoing what we call a geometric random walk, and this is the time series. It doesn't seem that it will ever stop going up. Okay. And similarly, if you look at the gold mining stocks, ETF, GDX, it shows a similar behavior. There's no particular pattern to it. It just look like a random walk, going farther and farther from the mean. Okay, however, here is an example of a stationary time series. You can see that it doesn't, it shows a distinct pattern. In fact, the pattern is obvious that you can call it mean reverting, because it looks like it is always going, whenever it's very far from, let's say, an imaginary line here, it tend to come back. It's very mean reverting. And now, if a price series that we trade is like that, it's stationary, it is obvious that we can trade it quite simply by a mean reversion strategy. What is a simple mean reversion strategy? Well, you must have heard of it. It's just buy low and sell high, and vice versa. Short it when it's high and buy cover when it's low. Just doing it over and over again will earn you unlimited profit. And in fact, that's what a lot of statistical quantitative traders do. Right? Mean reversion strategy is one of the basic money makers. Have been for many years for quantitative traders. But how do we know whether a time series or price series is suitable for this kind of strategy? Not every price series, as we've seen, most price series are not mean reverting and they're not stationary. So how do we test very quickly to see if a price series fit this criteria so that we can trade this mean reverting strategy? Well, that brings us to what is called the ADF test. It's a statistical test which tests whether the change in price in the next period meaning next bar, it could be 5 minutes bar, it could be 10-minute bar, but whatever it is, let's look at the change in price in the next bar. Is that going to be proportional to the difference between the current price and the mean price? If it is not proportional, it is a random walk, right? A random walk, the price change in the next time period is independent, is a white noise. You could not predict what the next price changes. It could be positive, it could be negative, it could be zero. But for a stationary price series, it is predictable. In fact, it is going to be negatively proportional. It is going to be negative proportional to the current price, to the difference between current price and the mean price. Or to put it other way, it is proportional to the mean price minus the current price. As if the current price is very low compared to the mean price, the change in the next period is likely to be up, right? So that's what mean reversion means. If it is below the mean, it tends to go up. If it is above the mean, it tends to go down. That's why it revert to the mean. So it will revert to the mean only if there is a proportionality constant that is different from zero and is particularly negative. So the statistical test is actually capitalized on this observation. It is testing whether the regression coefficient between the next period price change and the current difference between the mean and the price. And if we can reject the null hypothesis that that proportionality constant is zero, then there's a likelihood, there's a good likelihood that this price series is stationary, that it is mean reverting. I'm using mean reverting and stationary synonymously at this point. Okay, so that's called the ADF test. It's nothing but a statistical significant test of the regression coefficient to see if it is zero or not. Now, it's good that we have such a test, but unfortunately, if you run it on most time series, you will find that it cannot reject the null hypothesis, because most time series are not stationary. We have seen examples. GLD is not stationary. GDX is not stationary. If you apply it to SPY, you're going to find that it's not stationary also. So what's the use of having a test when most of the instruments fail this test? Well, not to despair, because we can construct a portfolio. We can construct a price series where it is stationary. All you need to do is to find two instruments, maybe Apple versus Microsoft, maybe Exxon versus Chevron, maybe Citibank versus JP Morgan. A portfolio of two similar stocks one long and one short. You cannot be both long. It had to be typically one long and one short in some proportion. And if you test this portfolio, sometimes you will result in a stationary price series for the portfolio. The price of the portfolio represents the net market value of the portfolio. Okay, what we call a price is actually more accurately the net market value of a portfolio of multiple stocks. Some of them are short, some of them may be long. And so we can apply the ADF test to this portfolio, and you will sometimes find that this portfolio is stationary. And if that's the case, the instruments themselves are called co-integrated. The portfolio time series itself is stationary, but the individual instruments are not, but they are called co-integrated, because when you put them together, they can be stationary. So they themselves, the instrument themselves, are called co-integrated. A good example of a number of co-integrated stocks would be GLD and GDX. In particular, if you construct the portfolio by long one share of GLD and short 1.6 shares of GDX, you'll find that the resulting portfolio is pretty stationary over some period of time. Here you have seen this price series again. I didn't tell you before, but this price series is in fact formed by shorting 1.6 shares of GDX and long one share of GLD. And you can see that, lo and behold, at least during that period, 1.5 year period, that portfolio is very, very much mean reverting. Okay, so to recap, what are co-integrating stocks? Well, co-integrating stocks are the stocks that can be chosen, that can be used to form a stationary portfolio. And a stationary portfolio is suitable for a mean reverting strategy. Buy when the portfolio is cheap and sell when the portfolio market value is high, and vice versa. So you trade the portfolio as if you were trading an ETF, okay, or trading a single stock. And okay, co-integration is a fancy term, but most of you have heard of correlation, right? If you have studied basic statistics, you will no doubt have heard of correlation. Well, they are different concepts. They are not the same. Correlation is typically concerned about the short-term return of two stocks and whether they are in the same direction. The short-term return could be minutes, hours, days, weeks, or even months. But nevertheless, it's concerned about returns over some period. But co-integration is not much about return. They are not interested in whether Coca-Cola and Pepsi go up at the same time. They're not interested in whether Google and Apple go up over the same period. What they are concerned with is whether the two price series diverge over the long term, not one day, not 1 month, but over a long time period, whether the two price series tend to converge or diverge or remain co-integrated. If they diverge, then it's not going to be co-integrated. For example, Coca-Cola and Pepsi have a fairly high, significant daily returns correlation coefficient of 0.48. It is statistically significant. They move up and down at the same time, half the time, very, very significant. But interestingly, they don't co-integrate. Over a long period, their spread, what we call the spread, which is essentially the portfolio of long one share of Coca-Cola and short 1.01 shares of Pepsi. That's a portfolio, or sometimes people call it the spread. This net market value of the portfolio is what people refer to as the spread, by the way. And this spread doesn't seem mean reverting at all. If you look at it, it for a long period of time, for 8 years, it just keeps going down. So despite the fact that the Coca-Cola and Pepsi move up and down half the time during each day, they are not co-integrated. If you form this portfolio of long-short portfolio, the spread is not stationary. You cannot trade it in a mean reverting strategy. Okay, so the two concepts are different. So it's even clearer if we illustrate it with two hypothetical time price series. So stock A is the one on top with a blue line, and stock B is the one at the bottom with the red line. These are the daily prices, and you can see that I've constructed these two stocks so that they are correlated. When stock A goes up, stock B goes up. When stock A goes down, stock B goes down. Their returns are very correlated. Okay, but now here is a example of two co-integrated stocks that are not correlated, A and C. So the stock A is again the one in the blue line, but the stock C is the one in the green line. You can see that when stock A goes down, stock A may go up. When stock C goes down, stock A may go up. So they are not correlated, maybe anti-correlated. But sometimes when stock C doesn't move, stock A still go up and down. Sometimes they go in the same direction. So they are not fully anti-correlated either, because here, when stock C is going down, stock A is also going down. And so here, when stock C is going up, stock A is also going up. So overall, you can see that they don't have any significant correlation of returns. They sometimes go in the same direction, sometimes go in the opposite direction, sometimes one doesn't move and the other moves. However, if you look at the spread of these two hypothetical stock, which is the stock C minus stock A, you'll find that this spread is very much mean reverting. It starts off positive, becomes very positive, becomes less positive again, it becomes negative, go to zero, become very negative, go up and back to zero, and then become small positive again. So if you can plot the spread of A and C, you will find that this spread is very, very mean reverting. So these two time series are very much co-integrated because they can be made to form a stationary portfolio, but they are not at all correlated because they can move in very different direction from day to day. And so to recap, co-integration is a very long-term behavior, is looking at the long-term behavior of the prices, and correlation is looking at the short-term behavior of the returns. Co-integration is about price, correlation is about return. Okay, so what are the kind of mean reverting strategy we can use? There are several, but the basic one that everybody should know is based on Bollinger Bands. Bollinger Bands is essentially using moving average to determine the mean, right? If you have a mean reverting strategy, you need to know what the mean is. So the mean in this case of the Bollinger Band strategy is given by moving average. But also in the mean reverting strategy, you need to know when is the entry level. The entry level in the Bollinger Band is determined by this volatility of return of the price series, or in other words, you can measure it by the multiples of standard deviation, or basically one standard deviation. If the multiple is 1, then you are entering if the price is away from the moving average by 1 standard deviation. What is this standard deviation? How is it measured? This standard deviation is also measured by moving window. So typically the Bollinger Band has one single moving window that can compute both the mean and the standard deviation, and they are used to determine both the mean of the mean reverting strategy as well as the entry level. And after you enter into position, if the price mean revert to the mean, you will exit. Now this mean is changing because the mean is a moving average, so it's changing all the time. When it exits, there's no guarantee that it's profitable. It could still be unprofitable. This is a subtle point that we'll discuss in the course. But nevertheless, you will exit whenever the price converge to the moving average of the price. How does that work for AUD/CAD? Wonderfully. Now, given that this is old backtest, you can try it now. And also there's another caveat, this is without transaction cost. Transaction cost is usually what kills a mean reverting strategy. On paper, it might look very good, but once you add in the appropriate transaction cost, which not only include the commission, but also the bid-ask spread sometimes, you will find significantly less well results. So do not be overly excited by this graph. Okay, and similarly, even for the euro versus Swiss franc, it is also very nice equity curve. Okay, again, given without transaction cost. Okay, so in summary, this course will cover the basic concept of stationarity and co-integration and how you can estimate them using Python, how you can compute whether a new time series satisfies stationarity criteria, and whether a bunch of time series can be considered co-integrated using a very simple, two simple statistical tests that will be covered in our course. And you will be taken through it using standard Python functions. And we will also be able to backtest a mean reversion strategy and see whether it's profitable. And then finally, you will be taken through some of the examples of index arbitrage and also long-short portfolio trading as well. Now, it doesn't mean, of course, that a pair of stocks that are not co-integrated cannot be traded in a mean reversion manner. It is not a necessary condition, but it is in a sufficient condition. If it is co-integrated, you can find a mean reversion strategy that works, but you don't need co-integration to necessarily trade it successfully in mean reverting trade if it is short-term enough. Okay, so with that, I'm going to give the floor back to Suzanne, and we probably going to be open to some questions from the audience as well.
Thank you so much, Dr. Chan. That was an excellent presentation. I'm sure the crowd thoroughly understood it and enjoyed it as well. We do have a lot of interesting questions coming in, so we will begin the question and answer session shortly. But before we do that, I just wanted to take a minute and show you the strategies that the concepts that you just learned right now, how you can implement them using Python. So I have opened here our Contra portal, which I was talking about earlier. So we have a course on Contra on mean reversion strategies in Python. I just wanted to show you how we can, how the course is designed and what are the features that we have and how you can learn by doing. So for example, this is the section on ADF test. Here we have the video section. Here we also have a subtitle section wherein if you click on the subtitle, it will directly take you to that part of the video, right? Same way, we also have a practice coding section here wherein you can type your code and it will run here itself. So like this, see, you can also maximize it and minimize it as well. That is the video section. What we also have is an IPython document or IPython notebook. Herein, it's a reading material, but it's just not a normal like a PDF reading material. This is also where you can practice your code. So for example, if I run this code, it will show me a chart here. If I change the value of it, it will still run and change the value and show you how the price is different for different values. So that's IPython notebook. Apart from that, we also have interactive exercises. Now this course thoroughly aims at having to tell you how you can learn the concept by doing them. As a result, this is an completely interactive exercises based on artificial intelligence. What you can do here is basically you have your context, your syntax, what are the functions that we are going to use, and here is your code. So what you can do, so for example, if you type anything and try to submit it, what will happen is that you'll get a message and it will prompt you on what exactly needs to be used. So if you copy that and paste it here and run the code again, what you can see is basically the next hint. And if you keep doing this, if you still can't get it, you can see the hints that are there. And even after, if you couldn't do it, you can see the solution code and you can just copy this and paste it and paste it, submit, and that should work. That's how you can do each and every exercise and go on building your own trading strategy. Again, learning by doing. Now, a little bit about the course that we have. The course is again designed by Dr. Ernest Chan. The course also covers 3 different trading strategies, which includes triplets. Triplets is the basis of mean reversion strategies, which was very popular back in 1980s. Then we also have index arbitrage strategy. This strategy you can use to take advantage of price variations in the indexes. Then the third strategy you have is the long short portfolio, which is again very popular with hedge funds across the world. Apart from that, we also cover what is called as a half-life concept, which is used in risk management, and best markets to trade for the pairs trade. All of these, again, I'd like to mention that all of the three strategies that I just mentioned are downloadable. That means you will get the downloadable code, which you can run in your own Python. Now we will start with the question and answer session. So Dr. Chan, I'm going to pass over the rights to you. Can you hear me, Dr. Chan? Yeah, okay, cool.
Yes. Okay, yeah, I see one question here. It is about whether mean reversion strategy is more reliable for triplets and quadruplets than pairs. In theory, it is. The more individual components you have in the portfolio, the less it is subject to random events that affect only one stock. It's more diversified. However, in practical trading, the transaction cost of trading more than two pairs can be quite substantial. So it's not as easy to implement in live trading as a pair trading strategy. Okay, so let me see what the next question is. Okay, let me just see. There's a question about whether this course will contain materials on Kalman filter. No, it will not contain Kalman filter. This is a mean reversion course for, I would say, the introduction to mean reversion. So it is not for people who already have done a lot of mean reversion strategy backtesting and are familiar with the basic techniques and want to learn advanced techniques. No, this is for people who have not yet backtested mean reversion trading strategies. So yes, this is not one for exploration of a Kalman filter. Okay, so let me answer that. There's a question about whether we will get the recording later. Maybe Sushant can address that.
Yes, Dr. Chan, everyone will get an email with the YouTube recording of the webinar, so that's there.
Okay. There's a question about whether the historical data what kind of historical data would be considered for backtesting and the time frame you're using mean reversion. Yes, mean reversion actually happened in many different time frame for different instruments. Some instruments have a time frame of minutes, others have time frames of days. And in fact, the notion of half-life is what's used to determine the time frame of mean reversion. And that's one of the topics that is going to be covered in the course. How do you compute the half-life of mean reversion? So depending on the time frame, daily data might be sufficient, or you might need intraday data, minute bars or even second bars, depending on what the half-life of mean reversion would be. Okay, let me see if there's any other questions. There's a question actually for Suzanne. Somebody, farmer had said that the link is not allowing us to enroll in the course. So maybe Suzanne can address that issue.
Sure, Dr. Chan. So the link actually is for our course page, wherein you'll have to click on the Enroll Now button. That Enroll Now button will take you to a page on Contra, wherein if you're not an existing user of Contra, then you will have to sign up for Contra. You can either do that using a Google or LinkedIn, or you can log in. You can sign up using an email address. If you do decide to sign up using an email address, then you will receive a verification link on the email ID that you mentioned, and you will have to click on that email verification link. And once you are thorough with the process, then you can log in and enroll for the course. I hope that answers the question.
Great, thank you, Suzanne. So Dean had asked whether the code we will make available, and I believe the answer is yes. The code is integrated to part of the all the exercises, so you will definitely see the code when you look at the solution. Another question is, will optimization be right to use? Okay, this course will not cover too many optimization techniques, and optimization itself is a, I would say, a rather controversial subject. It is deep and controversial. I personally don't use optimization, and I think there are some very knowledgeable industry experts in quantitative trading that will also tell you that if you do use optimization, you have to use it extremely carefully, because it is very easy to optimize many times on a trading strategy and made it super performing in sample, but completely fall apart out of sample. So optimization can be used, but it has to be used very intelligently and carefully. And it will not be discussed in this course. What's the next steps in the development of tools? Farhan said. All the tools that we use in this course are available as open source packages in Python. So, in terms of the next step in development, you should be applying these tools to your own favorite time series or your own favorite market to discover opportunities for mean reversion trading. Okay, so let's see. There is a question about the mathematical difference in correlation and co-integration. Well, as I addressed, the mathematical difference is obvious. The correlation, the input are different. So the way you measure correlation is usually by means of Pearson correlation function or the rank correlation function or the measuring the correlation of the signs, the three kinds of a way of measuring correlation, none of which are applicable to co-integration because the input are different. The co-integration measuring co-integration, one uses CADF test, or one measures it using Johansson test, and none of them have anything to do with correlation. The length of the course. The length of the course is okay. I guess Suzanne can address that. What one should.
Sure, Dr. Chan. Sure. So the course is 4.5 hours long in terms of the videos. But if you do also calculate the exercises and the coding sessions, then the course can be easily up to 7 to 8 hours. But again, this depends on the capability and the familiarity of the person with the coding as well as the Python environment. So this is a kind of a subjective thing, but on an average, it should take around 7 to 8 hours to finish the course.
Mm-hmm. Thank you. So there's a question about what is a null hypothesis. Well, a null hypothesis in statistics means that you cannot, that the number is zero. You cannot confirm that it's not zero. In the particular case that we're talking about, the number represents the regression coefficient. So the null hypothesis in this case means that the regression coefficient is 0, which in turn means that the time series is a random walk. What's the next step in doing this course? Okay. As I mentioned earlier, the next step is for you to apply the techniques used onto your own favorite instruments and markets and discover whether there are mean reversion trading opportunities. Next question is, what is GDX? GDX is a ETF that contains many of the major gold mining companies. Okay. I see. There's a follow-up question about what is the next step. The next step, okay, the follow-up is, what functions would a quant infrastructure have? More than just a stationarity test. Well, for sure, the course only covers the basics of the research phase, right? So first, you need to download historical data on your own favorite market and determine what time series are promising for applying mean reversion strategy. But once you decided that it is promising, you have to build an automated trading infrastructure to trade it live. And that is quite a different set of skills, because you need to be able to connect to your broker automatically. You need to have automatic historical data feed as input to your algorithm. Now, Suzanne can perhaps jump in here to discuss whether there are courses Quantra or Quantitative offer that talk about automated execution, not just the research part, but the actual connecting to the broker and trade it live.
Sure, Dr. Chan. We do have courses which will introduce you to the Python required for the finance part of the execution. Now, once you go through the course and once you do your sample strategies, coding and all of that, you will actually be able to code your own trading strategy and should be able to apply it to any broker's platform which supports Python API. So Python API support is a must for anyone to implement that. Why we have chosen Python is because it's free and it's available for anyone to use. Also, it is supported by a lot of platforms by brokers. So there is a course on Contra which is called as Python for Trading. This is for beginners and anyone can initiate their programming learning there. Thank you.
Thank you, Suzanne. So the next question is, does AI have anything to do with mean reversion strategies, and what AI techniques are suitable? Well, AI techniques certainly can be used for any trading strategies, but typically when you apply AI techniques, it will not necessarily tell you that it is a mean reversion strategy, right? Typically, AI techniques will just tell you, expect whether the stock price is going to go up or down. It will tell you whether you should buy or sell. It will not necessarily restrict itself to, this is a mean reversion opportunity only, and you should, trade it according to mean reversion. It is, less common for AI to distinguish that. So when you use AI, you are, kind of outside of the realm of mean reversion strategy. Okay, if you know that this time series is mean reversion, you will not need to use AI to trade this profitably. Okay, so let's see. That's a good question here. What's the basic knowledge needed to benefit from this course? I think that this course assumes basic statistics. If you are familiar with regression, how to run a linear regression, you should be able to handle the math. It's not that advanced, the math required. There is another question about an intermediate advanced course. I believe that there are more advanced mean reversion course that is offered at Quantitative. I don't teach the more advanced version of mean reversion. Maybe Suzanne can jump in about the next stage in mean reversion course, perhaps more advanced than this current one.
Sure, Dr. Chan. Yeah, definitely. So right now we do have plans to launch more courses, but that's the only information I can speak about right now. As and when we do, we will definitely notify all of our interested students.
Great, great. Okay, great. Let's see what else. Okay, so the question is, can we use a sector or segment index to which our interested stock belongs in place of a co-integrated pair directly for mean reversion? Farmer index, for example. Well, certainly you can apply the stationary test to the farmer index and to see that if it is stationary. My bet is it definitely won't be, because most of the index are long only. A long only index typically are exhibiting a geometric random walk, just like a single stock, with lower volatility perhaps than a single stock, but nevertheless it is exhibiting a geometric random walk. So the only way you can create a portfolio that is mean reverting is if that portfolio is contain both long and short stocks, and for that you have to create it yourself. Okay. Okay, so there's a question from Harry about is this mean reversion strategy applicable to both intraday or positional? As I said, mean reversion happen in all different time scale for different instruments. You have to apply the half-life test to figure out if it is suitable intraday or at a longer time frame. Is this course suitable if someone want to make a career in algo trading? Well, certainly it's the start. I wouldn't claim that just after taking this one course, you will be all set to become an algorithmic trader. You probably have several more courses to take. And more importantly, you need to apply the theory to practice before you can make a successful career. But certainly it is a good introduction, I would argue. Is there any market cost Python function? I'm not sure. You probably meant execution cost. Execution cost is something that you can easily incorporate yourself in your own code. I don't believe that's necessarily a standalone function in Python that let you incorporate that. However, there are complete Python execution package. For example, one that is created by Quantopian, or one that is created called I think it's called Backtrader, something or another one called Quant Connect. Many of them let you put in your estimate of the transaction cost, so you don't have to write the whole system yourself. Okay, so what is there testing platform? Yes, that's exactly what I was just suggesting. There are a number of the ones that are in the market that are free. There's Quantopian, Quant Connect, and there's, I think it's called Backtrader. Now, is searching for co-integrated pairs among the universe period? Yes, in some sense, whenever you do a search, there is a possibility of data snooping bias. So when you are looking for co-integration in sample, it does not necessarily co-integrate out of sample. But the good thing is that this type of in sample you could say in sample selection has less of a chance of overfitting than if you are going to optimize parameters, because in fact there are no parameters. You're just selecting the market to trade and assuming that the market behave in a in an overall way similar in the future, then your strategy will work. It does not require the specific. It's not arguing that the specific parameter that you chosen will work in the future. So it's a less egregious form of in-sample selection. And furthermore, you get much more data because a co-integration test is not a trading strategy. A trading strategy captures very few data because you don't trade every day, right? You might trade every week. So every year you might get 50 trades, very little data. But for a co-integration test, it is applied to a time series. And there's data every day, every minute, every second. So the statistical significance is much higher. Is mean reversion reliably better than long-term trading strategies? In one measure, it is certainly. A mean reversion strategy typically had a higher Sharpe ratio than other strategies such as momentum strategy or such as buy and hold. However, Sharpe ratio does not represent a complete doesn't cover all aspects of the performance of a strategy. In fact, it doesn't cover certain tail risk. So you can have a mean reversion strategy are subject to high tail risk. It is similar in some sense to shorting volatility. It is shorting realized volatility rather than implied volatility in this case, but nevertheless, it's subject to similar risk as shorting volatility. So the Sharpe ratio is high, you must beware of occasional tail risk. You can try to run mean reversion strategy on the VXX, not on the fixed index. You cannot trade the VIX index directly, but you can trade the VXX ETF or the VX future, and you will find that you might succeed. It's not pointless. You might apply the stationary test to VXX and to see if it is suitable for mean reversion trading. Now, again, there's a question about the time frame that mean reversion strategy work, and particularly, it is very much dependent on the instrument. And look back, the half-life is the measure that you can compute. The question about creating a Python continuous future, well, that's completely certainly outside the scope of this course, I'm afraid. Maybe Shusan can jump in to see if there are any courses on futures trading strategy, and particularly in constructing a continuous future. Actually, the momentum strategy, I don't actually, before Shusan answer, I do teach a quantitative momentum course in Quant still. In that course, we will discuss the pros and cons of using continuous future. A lot of that momentum course is on futures. So if you're interested in futures, take the quantitative momentum course. There's a question about, I would like to run a long short equities mean reversion strategy. Yes, it is feasible for a small retail trader, but I think that it depends on how small. You certainly require a account with minimum balance of about 120,000 US dollars in order to obtain the so-called portfolio margin from interactive brokers, for example, which may conceivably allow you to leverage 6 times. So you might be able to trade a $500,000 portfolio, half long and half short. If you are buying each stock just a few $1,000s, you might be able to achieve that with a $500,000 portfolio, and which requires equity of about $120,000. So let's see, there's a question about, I noticed you mentioned the Bollinger Band. Yes, how do you determine the look back length? That is a good question. And that's again, can be determined by backtest, or can be determined by running the half-life. So if you say you find that half-life is 6 days, there's no reason, you can certainly set the look back to be 6 days or more. But oftentimes that is indeed a free parameter for optimization. And if not trying to fit all kinds of numbers, you can start with something reasonable. 1 month, 1 week, something reasonable. Hopefully the strategy is not too sensitive to this parameter. Okay, so there's a question about no programming knowledge. If you have no programming knowledge at all, Suzanne can perhaps suggest what Python tutorial they can take before taking this course.
Sure, Dr. Chan. If someone doesn't have any programming background, I would recommend the course, same Python for Trading again. This course we have specifically designed keeping in mind that people who do not have any programming background should be able to utilize and get started with Python. This course is specifically skewed towards finance application of the Python. As you know, Python is a very large concept and there are a lot of libraries in it. So we have this course on Contra. You can see the link for Contra in the presentation right now. You can find the course there.
Great, thank you, Suzanne. Question is, how do you select parameters for the ADF test? Typically, you don't have to optimize that. The ADF test, typically, you will just select a lag of 1. You're assuming an AR1 model in technical language. You don't need to get fancy and select an AR2 or AR3 model. AR1 is usually plenty good enough. And you should assume typically that there is no drift in the time series. So these are the default parameters that I don't necessarily recommend you have to optimize. How to identify stocks for intraday arbitrage? Well, you have to apply the ADF or CADF test or Johansson test and whatnot on your stocks using intraday data and determine for yourself which stocks are suitable, which stock are co-integrating. That's the whole point of this course, is for you to identify those stocks, right, using the statistical test of co-integration. How to exactly predict where the real mean is? There's no way to predict exactly where it is. All you can assume is that the mean in the future is the same as the mean in the past. If you know where the mean is in the future, you do not need mean reversion trading. You can use a directional trading, right? Because if you can predict the mean is going to be 5% higher tomorrow than today, buy, right? You don't need to worry about mean reversion. Just trade in the direction of your prediction. The problem is most time we cannot predict where the mean is, and all we can do is to assume it's the same as the past mean. How many data points are recommended for mean reversion study? I would say as a rule of thumb, 100 data points. How is your course different from the free resource and lectures on Quantopian? Oh, well, I wouldn't say that that the concept is going to be completely original, because as you pointed out, mean reversion, stationary tests and co-integration tests, they are common knowledge. The question is, however, that this course provide you with exercises and solutions, right? So it is a proper course rather than just reading a book. Obviously, if everybody can learn by just reading a book, there will be no need for universities. Everybody can succeed by self-learning, but that's not usually how one learns. One learns by other channels than just reading, by doing exercises, by getting solutions, by getting challenged, by listening to the insights of a instructor that is not highlighted in a book. I myself have found that I can self-learn maybe about 30% from a book and missing 70% of the gist of what's being taught in a book, and maybe other do better than me. But I think that for me, I'm kind of an average student, and so that's why a course is beneficial in addition to just a passive reading of materials. How important is the weighting of two instruments in trading strategy? Extremely important. That's why the Johansson test will tell you what's the relative weighting. That's what is going to be covered. How do you determine that? What's called a hedge ratio is part of the course. How has mean reversion strategy worked out in today's market? Actually, in today's market, practically only mean reversion strategy work. Momentum funds have been in a drawdown for 2 years. So the only strategy that so far worked is mean reversion. And now I'm not saying that every mean reversion strategy work, only some work, but on the whole, they work much better than momentum strategy in this state. And there's a reason for that. And the reason is that mean reversion strategy are basically market making. They are providing liquidity to the market, and they are being rewarded by providing liquidity to the market. At the same time, they are taking risk because they are tail risk in mean reversion strategy. So from a risk return point of view, you are getting return in exchange for bearing the tail risk, just like people who are shorting options, providing insurance to other people. That's why in this calm market, mean reversion strategy work. Now, I'm not saying that it will not suffer a big drawdown when the financial market collapsed like it did in 2008. It could well suffer a big loss. But until then, that's the only strategy that works in the current market environment. I think that time is running out, but I think we'll take one quick question about how this course is different from the EPAT course that is on mean reversion. I think Suzanne can address that.
Definitely, Dr. Chan. So EPAT course is a more of a comprehensive course on algorithmic trading, and the way the EPAT course is delivered is through interactive online sessions which are conducted on weekends. However, Contra is a self-paced. That means you can do it on your own convenience, and it is not it is an interactive, but it's in a different way interactive. So that means you will see the videos, you will get interactive exercises, you will learn your concepts by doing. But the only question is that in EPAT you get to speak with the person who is teaching you and get to address your queries. Having said that, you can do that on Contra as well. We have a very rich community wherein a lot of questions are being asked right now. So the main difference between Contra and EPAT would be the format that it is delivered in, and that's about it.
Great, thank you, Suzanne.
Thank you so much, Dr. Chan. It was a very fruitful and very information-rich session. I'm sure all of the participants enjoyed. We did get a lot of interesting questions. I'm sure given the time we couldn't answer all of them. But what we will do is we will try and get back to you with most of the questions, as many as we could in next couple of days, and we will try to answer most of them. I hope this session was enjoyable and you learned something out of it. I again thank you, Dr. Chan, for taking your time out to share your insights and your knowledge with us. It was really a good session.
Thank you, Suzanne. I'm very pleased to be here with your audience.
Thank you. I'm going to disconnect the call now. Thank you, friends. Have a good night.